Good morning, everyone, and welcome back to day 2 of the Pinnacle Investment Summit. My name is Ramsin Jajoo, and I'm the leader of the Pinnacle retail business. But more importantly, I will be your host again for today's sessions. We have a big day ahead of us today, where we'll be tackling both the domestic large caps and Aussie small caps with the help of Lonsec Consulting and Mercer Consulting. For those of you who tuned in yesterday, we received excellent feedback from our audience who found the Research House introductory comments at the panel session very valuable. So please stick around for that session because there are great insights, not just from the PMs, but also from the Research House themselves. Well, during this morning's session, we're going to provide a comprehensive overview and insights into one of the largest allocations in client portfolios, that is Australian equities. So in a market, when index hugging has become more prevalent, it can reward you to be active, especially when the market is volatile, like we've had it this year, and especially throughout the pandemic period. Shortly, you will hear from 3 of the market's most respected, highly rated, and indeed very experienced active Australian fund managers. Namely, we're going to hear from Firetrail, Plato, and last but not least, Solaris. Each presenter will discuss from their point of view what structural changes are impacting the Australian share market, what sectors and industries are likely to be the winners, and of course, the losers over the next 3 to 5 years. How should investors think about future returns? Should we be thinking more income, or should we be thinking more total return and growth? And last but not least, what market inefficiencies can be exploited to generate alpha and excess returns for investors? Following our Australian equity presentations, we're delighted to have Veronica Klaus, Lonsec's Head of Investment Consulting, sum everything up in a comprehensive Q&A session. Our goal, just like yesterday and for the rest of the week, is to arm you with information that can help you build better and more robust portfolios. And importantly, we want to help you stay ahead of the curve. Okay, so before I introduce our first presenter, a couple of quick housekeeping items to ensure you get the most out of your experience on our digital platform today. You're logged on, so congratulations, you got to first base. The On24 platform we're using is fully customizable to give you a better overall experience. You can see on your screen lots of widgets and buttons, which will help you access further information and allow you to better engage with the platform. For example, please ask questions. I know your time is precious, so your engagement is vital. Download the presentations, access the CPD hours, customize your screen, or access further information on the great work our Pinnacle Charitable Foundation does in the community. As mentioned yesterday, any donations we receive today through the donate button will be matched by Pinnacle up to $10,000. So, our first session today will be by Firetrail, who will be presenting on Aussie equities. The Firetrail business was established at the start of 2018, whereby the whole investment team joined the Pinnacle Investment Group. They set up their own funds management boutique after having a long and esteemed history of working together at Macquarie. On that point, it's important to note that Firetrail investment team has the same investment philosophy. They have the same investment process. In fact, they even have the same risk management framework. What is essentially different is that the Firetrail team now owns their own business, and this provides full alignment with investors. Firetrail's track record in high conviction investing goes right back as far as 2005, basically before the GFC. And since then, the team has delivered over 2% per annum outperformance. It's also to note that Patrick Hodgins, Firetrail's managing director, has not only been managing the fund since then, but he was managing money right back to the 1987 market crash. So you're in very experienced hands today. In terms of Firetrail's high conviction approach, what makes the team different is basically is how they actually invest in Australian equities. Basically, the Firetrail team has a purely unconstrained process in a genuine high conviction best ideas portfolio. Basically, the Firetrail team finds stock opportunities irrespective of where they are in the market, be it value or be it growth. So without any further ado, please welcome Firetrail's Managing Deputy Managing Director. Sorry, Blakey. Blake Henricks. Over to Blake.
Thanks, Ramsin. Thank you. I love going to weddings, and one common but probably unspoken thought is whether I'm going to get the chicken or the beef when it comes to the mains. The good news for you is I think you can and should have both. And what I wanted to do today was present the case for uncovering really good opportunities in both value and growth segments of the market by focusing on what matters. Also wanted to do something probably that no investment manager has done in the past 6 months, is to deliver a presentation without mentioning coronavirus, starting from now. But to get into today, what I wanted to do was really outline 3 key areas. The first one is that beliefs are being tested. There's so many things going on out there. People are wondering what the future is. Secondly, is that one constant we absolutely do see is that short-termism creates opportunities. And finally, many are debating value versus growth as if it's religion. We strongly believe there's opportunities for both, and we'll highlight 2 of our best ideas in the space right now. So the key point of today is really demonstrating a proven approach to finding opportunities in today's market. The first thing I wanted to say was that beliefs are being tested across the market. The economic swings we're seeing are unprecedented. At the same time, the shift to online is creating winners and losers faster than we've ever seen before. And thirdly, valuations are dispersing massively. If you've got growth in a low rate environment, your share price is off to the races. If you don't have much growth, you're being left behind. So these beliefs are being tested with the current uncertainty, but there are a few things that you can really hang your hat on. The first one is this: every company has a price. It doesn't matter how good that beachfront apartment you buy is, if you overpay for it, it's going to be a bad investment. So every company has a price, recognises that yes, there are good and bad companies, but most importantly, there are good and bad investments, and that comes down to the price you pay. The other thing you can hang your hat on is you can focus on what matters to cut through the noise. Noise is ramping up. With the advent of social media and it taking off exponentially, everyone's got an opinion. Secondly is that with more of these opinions, more information, we're finding a lot more interesting articles, interesting views on companies, but it may not be what matters. And so focusing on what matters allows you to cut through the noise. And then thirdly, you've got to have the flexibility to capture both value and growth opportunities. These value and growth cycles have been shown to last, up to 5 years. And if you just closed off to one of those areas, you won't have as robust performance as you could have with more flexibility. So while there is a lot of uncertainty at the moment and a lot of people are questioning their beliefs, we believe this is a proven approach to investing. So how do we use short-termism to generate ideas? Well, many managers select stocks based on whether they're growth or value. But as I've mentioned, our view is both represent opportunities. So how do you look for them? Well, what you can see here on this chart is really a schematic of where growth stocks trade. They trade at premium valuations to reflect longer term growth. And you've got the value stocks which trade at lower valuations as a proportion of earnings or whatever it may be. So what you do when you want to use short-termism to your advantage and look longer term is you wait for some bad news. The market will typically overreact to bad news and even capitalise it into long-term valuations. And so what we're looking for here is either growth stocks or value stocks that are derated based on a short-term event that isn't going to be long-standing. Once you've got this idea and a framework, you can then go and look at what matters and work out whether that's reasonable or whether it's unreasonable and there's an opportunity there. But the key point here is that the market regularly derates both value and growth companies based on short-term information. So what I wanted to do now was to jump into 2 opportunities we're seeing in the market, both in growth and in value. And the first one is Seek. So Seek is the market leader in Australian job ads and helping employers place candidates into roles. They've got that dominant position in Australia. They've also got market-leading positions in both China and Southeast Asia. It is one of Australia's great growth stories. But more recently, Seek has been derated because of cyclical exposure to job ads. So while they are a growth company, they've done 18% revenue growth CAGR over the last decade, they're still impacted by lower job ads in the short term. And so in our view, this is the opportunity in Seek where growth has been cyclically impacted, and that means an opportunity for investors to look through. The second one, which is more of a value company, is Lendlease. Now, Lendlease is an integrated developer investment manager specialising in real estate. They've got leading positions in Australia, but also in 15 gateway cities around the world, places like New York, San Francisco, Milan, Chicago, and London as well. The D rating for Lendlease has come from engineering. You can see here a tunnel. Engineering was a business that Lendlease bought 10 years ago now for $1 billion. In the past year and a half, this business has lost $1 billion. Contract losses from doing these large-scale, fixed-price projects has meant major losses for shareholders and a very poor-performing division. So that's the opportunity where a small division has created a lot of problems for Lendlease. So in both cases, I think if you just step back for a moment, the D rating has been caused in the case of Seek by cyclical job ads, and in Lendlease by an engineering poor-performing division. We think the cyclical turnaround can happen, and for Lendlease, interestingly, from when I put these slides together to today, Lendlease has actually sold the majority of their engineering division, and so many of those problems are behind it now. If we step now into what matters, because this is really where the rubber hits the road. For Seek, what matters is who fills jobs in Australia. You can see in this chart here, of candidates that are placed that don't come from internal referrals, Seek really is the only game in town, placing more than 30% of candidates in job roles. Many of you may be thinking, but yeah, I spend a lot of time on LinkedIn. You can see here, when it comes to actually placing candidates, Seek is the dominant player. I think what gets quite interesting once you dig a little bit deeper is that you look at candidates and you put yourself in a recruiter's shoes. So the average or the median wage in Australia is $62,000 a year. If you're a recruiter, you'll take roughly 15% of first year wages as a fee. So $9,300. Now those recruiters are putting job ads on Seek, and at the moment, you're looking at $64 per job ad. We believe there's a major opportunity for Seek to close that valuation gap. And when I say valuation gap, the value they're providing to recruiters and SMEs by lifting prices over time. And it may not just be blunt price increases, but it's providing more value, saving HR businesses and recruiters more time by using their data. So the key point here is that Seek is a market leader with significant upside, particularly on the pricing front. When it comes to Lendlease, what matters for them is that they are the leader in global developments, particularly in residential, office and retail mixed-use precincts. You can see here, this is an artist's impression of a Google project. Lendlease was lucky enough a year ago to win a project to build 15,000 apartments with Google in the San Francisco Bay Area. Those 15,000 apartments have a finished value of $20 billion. This was a company-changing win in our view and really speaks to the credentials that Lendlease have as a global developer. But it's not a one-shot, and Lendlease isn't a one-trick pony. You can see here in the next chart just how much this development pipeline has grown over the past 7 years, from less than $40 billion to now more than $100 billion. So this is one of Australia's great global growth stories in waiting, in our view, and over the next few years, we believe cash flows are going to grow tremendously. But then let's look at valuation, because every company does have a price. You can't just buy good news stories and ignore price. You need to take it into account. And so in the case of Seek, consider this. FY22 EV to sales for selected technology stocks, Seek's right down there at the bottom. And we believe a lot of that has to do with the cyclical impacts of jobs at the moment. We also support that valuation because this isn't a core metric, but for us, looking at long-term cash flows such as discounted cash flows really speaks to the value on offer in Seek compared to some of these other high-quality businesses. When we look at Lendlease, we see a lot of growth as that development pipeline matures, but some of that development pipeline is actually going to go into an investment management division. And so today, Lendlease manages less than $40 billion of funds under management. We see a really plausible scenario where Lendlease could be managing over $100 billion of investment management over the coming years. And so I think what's really important here is not only are earnings going to grow, but it's going to grow in higher quality areas with more recurring revenue nature, such as investment management. So Lendlease is shifting towards a higher value recurring earnings model over time. So just let me put those two ideas together for a moment. Both Seek and Lendlease derated on what we believe are going to be short-term concerns in cyclical job ads and in engineering. You've got what matters, which have highlighted really strong businesses with massive growth potential. And then finally, you've got valuations both in SEEK and in Lendlease, which speak to a lot of upside. So today I set out to really, prosecute the case for investing in value growth and focusing in on what matters to find the opportunities. While a lot of people are questioning their beliefs at the moment, there are proven approaches that are critical to success, and we highlighted some of those. Short-termism will always provide the opportunity. That is the behavioural bias that we see time and time again. And while many are debating value versus growth like it's religion, we absolutely see the opportunity for value and growth. Now, at your next wedding, you probably are going to have to choose between the chicken and the beef. But if you invest in the Firetrail High Conviction Fund, we'll make sure you get the very best value and growth stocks we can possibly find. Thank you.
Thanks, Blake. Plenty of insights. And I can assure you, at my next formal function, I will ask for both meals. So let's see how far that gets me. Now, Blake will be back for our Q&A panel session, so please keep your questions rolling in. And I'm really looking forward to his deep insights on that panel. We will take a 30-second break just to swap presenters, and we will be back shortly. So thank you. Welcome back, everyone. Next up, we're going to change focus from high conviction investing to how to deliver consistent, reliable high income for retirees. And right now, this can't be a hotter topic considering we're not only in a lower for longer interest rate environment, but an environment where you need to be active in terms of income generation and, most importantly, avoiding dividend traps. Plato are our next speakers, and they have really challenged the norm of investing by establishing objectives-based, high-income equity solutions, especially for low-tax investors such as retirees, which if you think about it is quite unique because most managers are managing money for all tax brackets and all investors. And because Plato manages their investments specifically for low tax, it means that they can be rather unique and innovative to deliver a consistent high-income portfolio. Suddenly, portfolio turnover is irrelevant and capital gains tax is no longer an impediment. It's important to note that Plato does this without being permanently overweight banks or other former high-yielding sectors such as REITs, telcos, or even infrastructure stocks, which we covered yesterday. The outcome has been that Plato has been able to deliver over 9% income per annum since inception, and the Plato Australian Share Income Fund has also outperformed the broader market and the ASX 200 on a total returns basis. To tell us more about equity income investing, I'd like to welcome Dr. Don Hamson, or as we like to call him, Dr. Franking, to discuss why dividends still have an important role to play for investors, especially retirees. Welcome, Don.
Thank you, Ramsin. Well, many people are saying that dividends are dying. The AFR says that they've slowed to a trickle, that they've gone. But I'm here today to tell you that dividends are still well and truly alive. I say long live dividends. In this uncertain world, there's only one thing I think that is pretty certain, and that is that actually what has slowed to a trickle has been cash rates. Cash rates are now as near as damn it zero, and we expect, and the market expects, that cash rates will stay around 25 basis points to zero for the next 2 to 3 years. I mean, even before COVID hit, the RBA governor was saying that we'd expect interest rates to stay low for a considerable period of time. Now, it's even lower for longer. That is a certainty, I think. But those low cash rates have dragged down similar assets. So you see that term deposits, and on this slide, the cash rates are the grey bar right at the bottom there, hedging into zero. The red line is term deposits, a series we get from the RBA, and they're now sub 1%, a one-year term deposit. And even if you start taking some credit risk, the RBA has a series which looks at BBB rated 3-year investment grade bonds. And the yield on those has actually now fallen below 2%. At end of July, I think it was 1.7%, which is not a lot of extra return for taking on that investment grade credit risk. But other more risky assets have also fallen. Clearly rents are falling, as we see shopkeepers are doing it tough, so are domestic residential renters. But also dividends have fallen. And we were out there quite early saying we expected the market to cut dividends by 30%, and dividends have come down. But in a relative sense, they still look pretty attractive. I mean, you can see from this slide, the blue line there is the gross yield on the Australian equity market, just the ASX 200. And the dark blue line at the top is the historical 12-month rolling yield on the Plato Australian Shares Income Fund, which just dipped below 8% at the end of July. So it's still a pretty attractive yield. Indeed, some might say it's even relatively more attractive. On this slide, we actually divide the yield from either the market in light blue again or the Plato Australian Shares Income Fund by the one-year term deposit rate at the latest available. And when we launched our fund about 8 or 9 years ago, we were generating about twice as much income as a one-year term deposit. We're now generating about 8 times what a term deposit is yielding, largely because the term deposit rates have gone down so rapidly in the last couple of years. You can see that large increase there. So in a relative sense, we think equity income is still very good, despite the sort of 30% cut in dividends across the market. But I think some investors, income investors, clearly probably don't share our views, because if you look at the traditional income stocks, such as the big four banks and Telstra, they have really struggled over the last 3 or 4 years. It's surprising, we've been running this chart for 3 years now, and it just keeps on keeping on, in that Telstra and the banks have continued to underperform the market in price terms, so they're actually underperforming in total return terms. They've also now all cut their dividends. I mean, Telstra cut early and cut its dividends by almost 50%, so that's one reason why it's struggled in the last 3 or 4 years. But the banks have been somewhat late to the party, as we've seen the impact of the Royal Commission, but more recently the bad debts due to COVID. So it's been a real struggle for those investors, because not only are they seeing their dividends cut, but they're also seeing their returns significantly underperforming the market. Now, we're very happy, as Ramsin has said, that our fund has not only delivered strong income, but we've actually been able to outperform the market over this tough time for traditional income stocks. Tell you how bad it's been actually. We've got a pie chart there, and when we started this slide, Telstra was in the top 6. If you look closely, you'll find that Telstra is no longer in the top 6 dividend payers in the market because it's cut its dividend so much. And if we look deeper into what's happened in the market over the last 3 or 4 years, you can see a significant decline in the level of income, or proportion of income that's delivered by the finance sector, re banks, and by the telcos, Telstra. At the same time, though, the market is self-correcting. You've seen that there's been a big increase in the actual dividends delivered by the metal stocks, and in particular, that's Rio BHP and the pure play iron ore miner Fortescue. They've more than doubled their income over the last 3 years. And whilst it's still an incredibly small base, there's some little gold stocks that have significantly increased their dividends. In fact, gold's proportion of the market's income has almost tripled over the last 3 or 4 years. So some small diamonds there in that gold sector. Moving to the banks, or back to the banks really though, we see them to be a bit of a struggle for a number of years. I mean, they're now got the impact of reduced earnings due to COVID and the bad debts that are coming from that. And at the same time, APRA has come out and basically told them you can pay out no more than 50% of your earnings in dividends. So if your earnings are depressed and your payout ratio is lower, then your dividend's going to be much lower. So we saw even what we would say arguably the best of a bad bunch in Commonwealth Bank cut its final dividend by more than 50%. And regional player Bendigo and Adelaide Bank actually declined to pay a final dividend, so it omitted it completely, and Westpac similarly cancelled its already deferred interim dividend. So there's a lot less income coming from the banks. But luckily, those iron ore miners are actually taking their place. In fact, arguably, we're talking about the iron ore miners becoming the new banks or the new cash cows of the Australian market, and particularly the pure play stock Fortescue. I mean, Fortescue tripled its ordinary final dividend in the recent reporting season. So it went from 24 cents to $1, and is actually trading on a 14% gross yield. Now, normally we would think that a stock on a 14% gross yield is a dividend trap, but the reality is Fortescue's earnings are up 60%, its share price is up 60%, and it's still trading on a 14% gross yield. And BHP and Rio, they've got other areas that are holding them back, particularly BHP with some of its oil and gas assets, but they've still got traditional bank-like yields of sort of 7-8%, which is not too shabby in this market. So thankfully, the iron ore miners are doing some of the heavy income lifting. But it's not just the miners. If we look at the retailers, whilst a lot of retailers are struggling, particularly the little clothes shops and those sorts of things, some retailers are doing really, really well. There may not be a sausage sizzle at Wesfarmers anymore or down at Bunnings, but their sales are certainly sizzling. So too is Officeworks. Wesfarmers owns both Bunnings and Officeworks, and their sales is going through the roof. As is JB Hi-Fi. We're all sort of resetting the home office, buying new computer screens and you name it, and their sales are really going well. And JB Hi-Fi almost doubled its final dividend. So there are some pretty good income players out there. And of course, we all know about the sales at Coles and Woolies have been very strong. So the retailers are doing well, but not all stocks are doing well. We go on about the key to income investing is picking the right stocks that pay good dividends. It's also avoiding what we call the dividend traps. And I suppose the bad news on this front, if we have a model that aggregates the sort of, or looks at each individual stock, and then we aggregate this model across the market. And what we do in this model, we try and predict the likelihood that a stock will cut its dividend. And what this line or this chart does here is actually highlight that the likelihood of dividend cuts spiked very quickly in March, April this year, to a level that was actually higher that exceeded the GFC. So that things were pretty bad, which is why we came out very quickly and said we expect the market to cut dividends by at least 30%. The good news about this model is, if you actually look at the right hand of this slide, you can see that the probability has come back fairly sharply. It is still at elevated levels. It is still a lot more than normal, but it is getting better, which is the good news, as we find that the impacts of COVID are probably not as bad as we may have initially thought. But there are still plenty of dividend traps out there. Here are just a few. Remember, a dividend trap is something that, I suppose the simplest way of saying it is, it's trading on a great historic yield, or it used to, And then it comes along and says, gee, things are pretty bad, let's cut our dividend. And maybe they cut it completely to zero. We've got 3 stocks here that have done that. So Crown, obviously the casinos are closed, under a lot of trouble. At the end of March, you could have bought Crown on a gross yield of close to 9%, but then it paid no dividend, so you get no income. Similarly, we've already talked about Bendigo and Adelaide Bank. They, excuse me, failed to pay a final dividend, so they were trading on a 15% gross yield. And that's got to be a bit of a giveaway if they're trading on a 15% yield because the share price has fallen away due to COVID. The market's telling you that there's something wrong with that stock, and indeed it failed to pay a final dividend. And similarly, Centra, clearly retail landlords are struggling, and they failed to pay a final distribution. So there's plenty of dividend traps to avoid out there, which is why you've got to be on your toes if you're an income investor. Indeed, the problem with COVID is that its impact is not evenly distributed. We call it the good, the bad, and the ugly. Here are the top 20 dividend payers from last year. So they're not the top 20 stocks, but the top 20 dividend payers. And basically, there are some stocks, like we've mentioned, Rio, BHP, Fortescue, doing pretty well. Wesfarmers, CSL, not a high-yielding stock, but its dividends are well supported. Its sales are very strong. And Woolworths is in the top 20. Coles misses out. Those stocks are doing very well. Commonwealth Bank, say, the best of a bad bunch in the banks, and Westpac's probably the laggard, having not paid a dividend at all. So, it is a real mixed impact of COVID, and investors need to be very alert, very dynamic, and they need to be very active, because if you're still in those banks, you're going to struggle for income. Now, we've got Telstra there in the good stocks, which might be a little controversial because it has cut its dividends 50%, but that was about 3 years ago. It actually maintained its dividend in the latest reporting season, so that's why it's in the good. It's relatively good, but it's already had those big cuts in dividends. So finally, in summary, we don't think the dividend picture is as ugly as many people are painting. We don't think dividends have slowed to a trickle. What we can be fairly certain about is that interest rates are going to stay low for longer, or even lower for longer. I think cash rate's going to be around zero for the next 2 to 3 years for sure. And on that basis, equity income still looks pretty good, particularly if you adopt an active approach and go to where the dividends are, because there are plenty of good dividends out there. Yes, we stick with our 30% plus sort of cut for dividends at the market level, but you look to your Fortescues and your Wesfarmers that are increasing dividends, and your JB Hi-Fis, and there are still plenty of good dividends out there, which is why we still expect to generate around 7% gross yield this financial year, which we think stacks up pretty well relative to the income levels on other asset classes. And finally, I think given the uneven nature of the impact of COVID, I think it's very important to follow a very active approach and look at your portfolio closely, because there are plenty of dividend traps out there. There are plenty of stocks that used to pay great dividends and may not be paying dividends at all for 3 or 4 years. So it is very much a stock picker's market, and avoiding those dividend traps is more important, I think, than ever. Thank you for listening.
Thanks, Don. That's a great presentation. Whilst Blake did not want to talk about COVID-19 over his 15-minute presentation, we can't say that COVID-19 hasn't had an impact on dividends. And as always, Don, you made a very strong case why there's never been a greater need to have an active approach to delivering high income, especially for low-tax investors, such as retirees. In fact, my key takeaway from that presentation was that 7% grossed up income is very attractive, I'd say, in the current market environment. And that might be a bit of a surprise for some investors out there that have been listening to perhaps that fake news that dividends are gone. Now, audience members, I would like to bring to your attention that Plato will be showcased at the upcoming Portfolio Construction Forum Strategies Conference. So any of you that want to do a deeper dive in what Don just spoke about, the PCF will give an excellent opportunity for you to tune in and hear from Don a little bit more on equity income investing. The PCF program normally has very good academics and investors from global that tune in. And Pinnacle this year have become faculty partners. We've managed to secure some complimentary registrations. So for any of our audience members that do want to attend the PCF in a virtual environment, The dates are 30 September and 1 October. Please contact your Pinnacle director and we'll make sure that we get you that registration. They are limited, so please get into contact with us as soon as possible. Now, next session is Solaris, but we will take about a 30-second break whilst we... Given the Solaris is in Brisbane, we're going to go straight to Solaris. So let me just carry on and introduce Solaris. So last but not least, we turn to the Solaris presentation. We are going to be joined right now from Brisbane by Solaris's joint CIO, Michael Bell. In terms of the background, Solaris is an Australian equity funds management boutique, have delivered outperformance over the index in 16 out of the last 20 years. What an amazing achievement in a market where people talk about passive. Well, these guys are generating consistent excess returns. Solaris adopts a style-neutral approach to investing in Australian shares. So basically, Solaris are not going to be held hostage to either growth or the value style. Solaris are also one of the very few fund managers who truly back their investment capability by having an investment offering with a zero management fee. Basically, they will only charge performance fees if they outperform. What an attractive proposition for clients that are concerned about fees or are interested in getting passive exposure. In this case, you can get passive if they don't outperform, or you get excess returns with some performance fees. The core of the investment team has been together at Solaris since early 2000s, so they have experienced hands in managing portfolios in both up and down markets. They have a great ability to cut through the noise, assess the facts, and translate them into solid, consistent investment returns for their investors. On that note, I'm going to hand you over to Michael from Brisbane. Welcome, Michael.
Thanks, Ramsin. Appreciate it. I'm Michael Bell, Joint Investment Officer at Solaris Investment Management. So the biggest hot topic on our clients' mind at the moment in the many presentations that we've given them is what is happening to growth valuations? Are they going to continue? And what is happening to value? Is it just going to continue to bobble along the bottom? And in this presentation, I'll go through the markets that we've seen in the last 6 to 12 months globally and then in Australia, and then valuations. Where are we in terms of valuations? And then justifying those valuations. How do we justify the levels that we're seeing across the market? And then finally, having a look at some of the stocks in growth and value that we like and dislike, and then from there. So we might start with the markets. So the most important slide on this page is that the top left one, the Nasdaq, which is the green line, and interestingly, it's way above where it was pre-COVID levels. So that is, Nasdaq is full of tech and growth companies. And when I think about recessions and going through recessions, I've always thought about the market being down at least 15 to 20% in that environment. The S&P 500 is trading at about where it was pre-COVID levels, and our market isn't quite doing as well as the global peers, but it has bounced back a fair way. In terms of where we are in Australia, so over the last 7 years, we've seen interest rates. You can see the top chart there in the blue. The interest rates have dropped from 3.8% down to 0.9% now. And interestingly, that 0.9% was reached in about August last year, so pre-COVID. So expectations for interest rates haven't done a hell of a lot since COVID's come along, and that all happened pre-COVID. Interest rates, the RBA interest rates, in fact, have fallen about 50 basis points in that time. But the most important slide I really want to show you on the chart on this slide is that growth value defensive performance. So within Australia, where has the performance come from? And you can see over the last 2 years, the growth part of our market has rallied about 100% versus value, which is sort of bobbling along the ground at flat. And even at the bottoms in COVID, we've rallied about 100% in terms of performance for growth, and value has rallied a little bit, but not much. So how do we justify this performance of the growth companies versus the performance of the value companies? And in order to do that, we need to see where the valuations for these companies are at the moment. So that top chart that we see in the presentation, and really the only important line there is that blue line, which is the industrials ex banks. So stripping out banks, stripping out resource companies, we see the market is trading on about 24 times. And you go back to 2012, we were trading on 12 times. So we've seen a material re-rate in valuations across the market. And if I go back to in my 25 years of working in the markets, the closest we see to 24 times is the 22 times we saw pre-tech wreck in February 2000. So valuations are definitely up there. In terms of that industrials ex banks, if we then break that down again into growth and value stocks, and that's the slide down the bottom, we can see growth stocks have had a massive re-rate over the last 8 years, from some 20 times earnings to where we are today at about 40 times, whereas value has continued to sort of be around the 15 times. And that's the biggest dispersion between growth and value I have seen, and which is quite amazing. Interestingly, we've seen a number of the tech companies, their founders and insiders actually look to take some off the top and sell their holdings. So the likes of Kogan, Xero, Afterpay are just some of the names. And look, you can't blame these guys for taking some off the top when the companies have re-rated to the extent that they have. But the question that you should be asking yourself and your clients should be asking you is it justified the growth companies being at 40 odd times versus value companies at 15 times? And I'm going to try and answer that in the next slide for you. And I'll answer that somewhat, and I'll answer it in three ways. So growth companies can have a higher evaluation relative to where we were 8 years ago before interest rates started really materially falling. And the three reasons why is sensitivity to changes in interest rates, the rise of tech disruption, and to a lesser extent, the scarcity of growth. So if I start with sensitivity to changes in interest rates, as analysts, we are running DCFs on all the companies we model. And as part of that DCF, the risk-free rate or your interest rate expectations are a component of your DCF. And so if we get a fall in the risk-free rate within that DCF, then those future cash flows are discounted by less, increasing our valuation today. So across the whole market, if we get a drop in interest rates, we can find that the valuation for the whole market can increase. And we've seen that in the industrials ex banks. So we're now trading at 24 times, as I said in that previous slide. In terms of growth companies, and you can see the blue line in that chart that we've got there, that is a very different shape to the yellow line, which is the industrials ex financials. So a drop in your risk-free rate or your interest rates has a much bigger impact on growth companies than it does have on the rest of the market. And the reason being is that the cash flows for growth companies are much greater in the future. So much more of their cash flows are in the future than they are today. So those cash flows are being discounted less. So you are seeing the valuations for growth companies can go up a lot more than they do for the rest of the market. Interestingly, I showed you on the previous slide the valuations for the market have increased materially in the last 6 to 12 months, yet the interest rates expectations haven't fallen nearly as much in the last 12 months. So I said I'm flat in the last 12 months at 0.9%, which sort of begs the question, we're getting a little bit carried away here in terms of some of the valuations. So 12 months ago, we were 30 times for the growth stocks. Today, we're 40 times, yet we haven't seen that interest rate fall. So that's the first, and that's the biggest component of explaining high valuations. So there is justification in terms of lower risk-free rates or interest rates in having higher valuations in the market. The second one is the rise of tech disruption. So those companies that embrace tech in our market have the opportunity to be rewarded in terms of higher profits through lower costs, higher revenues, and higher valuations. So an example in our portfolio is James Hardie. So the building materials company, they have operations in Australia, New Zealand, Europe, and very large operations in the US. Now, they at the moment are using geospatial technology to analyse neighbourhoods and detect under penetration of their product within those neighbourhoods. So they are more effectively using their marketing spend, so the cost, and potentially raising their revenues through higher sales and focusing on those markets where it counts. And so in those cases, you can demand a higher valuation. And for James Hardie in their last result, they announced higher margins. They also announced in an industry where they're seeing flat demand for product, they're actually gaining market share. So they're winning out of this tech disruption. The third point I wanted to make out of this is scarcity of growth. And this is less important, but it is a factor in Australia. So in Australia, we just don't have as many growth stocks compared to many countries globally. And so in Australia at the moment, we tend to command, we have higher Ps for the companies that we've got because there just aren't as many companies. Now, how does Solaris apply all of this thinking in how we invest? If I go through to the next slide, we're not beholden to any particular style in our process. So our analysts will look at growth and value opportunities where they lie, and the strategy is designed to produce consistent outperformance in markets over time. And you can see right at the moment we've got our sort of smallest bias to value names. So that's the blue line on the chart on the left that we've had in a long time. So we're actually seeing some interesting opportunities in the value space presently in the markets. Now, what I'll do now is I'll go through and have a look at some of the growth companies we like, some of the growth companies we don't like, and just talk through some of those examples. So 3 companies which are looking a little bit expensive for us at the moment are Afterpay, Xero, and Domino's. Afterpay is an exciting company. They've done very well. Their penetration in Australia and New Zealand has been great. They're expanding into Europe and expanding into the US. Unfortunately, their barriers to entry we find are quite low, and there's numerous copycats hot on their heels at the moment. So we've got PushPay, we've got OpenPay, we've got Laybuy, we've got Sezzle, we've even got PayPal. Announced a couple of weeks ago that they'd be looking to go into that space. And in Australia, the banks have just announced zero interest fee credit cards. So it's going to be really interesting for them. As I said, we do like it, but we just can't get there on valuation. If you look at the chart on the left, this is a chart that shows the correlation between the share price in the blue and the earnings expectations for the market in the red for the year 2022. And you can see earnings expectations haven't changed much over the last couple of years in terms of Afterpay, the red line. They've actually gone down a bit. Yet the share price in the last 6 months has rallied from $20 to $100. And you can see a similar effect in Xero and Domino's. In those cases, we've seen earnings downgrades to consensus for 2022. So it's the market, yet the share prices have rallied materially. And what we're seeing both here and globally is more of a rising tide lifting all boats. And so with valuations looking pretty richly, there are pockets of the market that in growth that are looking particularly expensive and that we're worried about. And 3 stocks here are the ones that we are particularly worried about, where they've run way too hard. Now, in terms of your next question will be, well, what do they like in the growth space if they think that pockets of the market have run too hard? And what we do like, 3 examples of what we do like in the market are Goodman, Altium, and Appin. Goodman, for example, is in the REIT space. They deliver global logistics solutions to a number of their clients, and they are exposed to some of the faster growing parts of the economy. Some of their bigger clients are Alibaba, eBay, Amazon, and they've got a strong pipeline of opportunities into the future. And so many years of growth to come through. But the most important thing that I see in this slide is the the chart on the top left, which shows the expectations for earnings rising over time. So that's the red line versus the share price. So there's a strong correlation there between the share price move and the change in earnings. So that's really important, that our growth companies don't get too carried away with themselves and don't run ahead of themselves like some of those other examples I've talked about. In the case of Altium and Appum, similar sort of effect you're seeing there. Rise in earnings is seeing a rise in the share price at the same time. Now, it would be remiss of me not to talk about value opportunities, particularly with growth multiples at such extreme levels and value stocks being left behind. And we have been seeing opportunities over the last 12 to 18 months in the value space, and COVID has provided some pretty good opportunities to increase positions in quality companies. So 3 of those companies, Orica, Scentre Group and Horizon, not everyone's flavour of the month, particularly in the case of Scentre Group, but retail's not dead for Scentre Group. The structural change has been around for many years. They're trading at a massive discount to their discounted NTA, so now they're trading at about a 50% discount to their NTA, and that was discounted from $4.49 in December 19 to about $3.67 in June this year, and they're still trading at a massive discount. In the case of Orica, which is one of the companies I personally look after, they are a global explosive company that has some operations in Latin America, so it's not massive in the scheme of the Orica world, but they've been hit by COVID, and it created a great opportunity to increase our position there. The chart on the left shows and the axis shows where the market multiple is. So the market multiple Industrials ex Banks is 1, and Oracle is trading at a market multiple for the last couple of years, and it's just recently it's derated materially. Now it's trading at about a 30% discount to market. Now, I talked about in the growth opportunities, those who embrace technology can command a higher valuation. Oracle is one company in the value space that is embracing technology. They've produced a wireless initiating system, which they're trialing with their biggest clients globally, so BHP, Rios, etc. And what that'll do to their clients is it'll increase their productivity. They'll be moving less overburden, and so it'll lower the costs for the big miners. At the same time, it'll bring higher revenue for Orica and higher margins. So over time, I expect Orica to command a higher multiple, and it may not happen in the next 1, 3, 6 months, but in the next few years, we expect Orica to materially re-rate, given embracing technology and the growth going forward for Orica, which I'm seeing as high single digit for the next 3 years. So in summary, at Solaris, we believe that to some extent the valuations we're seeing in the market are supported by these lower interest rates, but you really need to have a view that interest rates are lower for longer. Now, if interest rates expectations start rising, then all bets are off, and growth companies will underperform in that environment, and they'll materially underperform and devalue. And in that case, the value companies start doing well. So, and you see that record underperformance of value turning round. So for active managers like Solaris, it's a great opportunity to have a balanced portfolio of both growth companies and value companies, particularly where the extremes of the market are at the moment. Now, in terms of Solaris, as Ramsin said, you can access us via our Solaris Long Short 130/30 product and also via our core product. And we have our Zero MER product, which only charges performance fees if we outperform the index. So thanks for your time today.
Thank you, Michael, for that detailed overview of where there may be some risks in the market and how Solaris is still finding opportunities both within the value and the growth spectrum in the market, despite the current market valuations. It was good to see that in Brisbane it's another sunny day, and I don't know what it is within the air of Brisbane or within the water that they drink, but 3 of our affiliates are up there, you know, be it Solaris, be it Hyperion, be it Riparian, and they all seem to deliver and generate strong returns for investors. So Queenslanders are absolutely punching above their weight. Now, yesterday we did promise you that we had a program that was short and succinct, and the managers are firing through their content, which is good news for our audience. We can take about a 3-minute break whilst everyone refreshes their cup of coffee or tea or a glass of water, and we can then kick off our panel session. In the meantime, I am going to introduce Lonsec, and it is my absolute pleasure to introduce one of Australia's leading investment research houses. So Lonsec Consulting is headed up by Veronica Klaus. She is highly regarded. I've certainly used in a previous life when I used to run an investment committee, and Veronica and her team do some excellent work with multi-managers, with MDA providers, with independent practices, and they provide asset allocation, they provide fund research, and help other implemented solutions in the marketplace. Veronica will start the Q&A session with some introductory comments. So I do encourage you to stay around, because it's always good in these times to hear what the researchers and what the consultants are thinking about and seeing what kind of questions they're asking of the portfolio managers. So whilst we set up for the next couple of minutes, please can you complete the survey question. These sessions are all about you, and the more feedback you give us, the more we can tailor our future content. And of course, we do have a panel of our PMs and investment professionals answering questions. So please take the opportunity, if you have any questions, feed them through to our team, and we will respond to you basically in a timely manner today. And don't forget to click through to the CPD hours. Portfolio Construction Forum is our CPD partner. So by clicking on to the CPD hours, you can start that process today and not wait for weeks to get your accreditation. On that note, let's just take a couple of minutes. We will restart 11 o'clock on the dot. See you shortly.
Welcome back, and thank you again for joining us. The last 9.5 months have really been some of the most exceptional months many of us have ever experienced in the financial services industry. You know, we went from having, you know, the ASX hitting a peak in February through to not even a month later having the fastest crash we've seen in history. And really this was all, as we know, you know, as we started to realise that this pandemic was going to have a very significant impact on the economy. You know, during this past few months at Lonsec Research, we've spent quite a few months researching and reviewing, as part of our annual review, the Australian equity sector. And as you would expect, a lot of the conversation has been around the pandemic and how the fund managers have been realigning their portfolios to be able to cope with the changes that have occurred. I think, you know, at last count, there was approximately about 220 individual types of funds that we rated. We saw about 15% of those have a ratings change equally between both upgrades and downgrades. But I think what was most interesting was the thematics to come out of it. And, you know, one of the most significant being that those managers that were really very flexible and nimble in the way they approached their portfolio are the ones that managed to get through that sort of March, April, May period the best. They were the ones that were able to shift their portfolio very quickly, to take into account the fact that now the world looked like it was changing. We were no longer, you know, seeing any sort of growth indicators coming through, and they were able to realign very quickly to be able to move to this new world. There was very much a renewed focus on balance sheet stress tests, you know, on a very basic level. Just about every fund manager we spoke to went back to basics and did a balance sheet stress test on every single company in their portfolio. And at a very basic level, it was, can this company survive with zero income earnings over the next 6 months? Interestingly, if we look a little bit deeper and we look very much at style, we all know that, for example, value managers have struggled for, you know, on and off close to a decade. But it was interesting that leading into the end of 2019, as we started to see some of these value indicators come back into favour, a lot of these managers had repositioned their portfolio for what they thought was going to be an economic recovery. Quite obviously, they were on the wrong side of that come March, and their portfolios suffered accordingly. And they've really struggled since then. And I think if you think about the types of companies that typically at least offer some kind of downside protection during these types of environments, those were the very companies that actually suffered even more. And I've heard the expression that it's a bit of the COVID black swan if you think about what happened with especially tourism type stocks and gambling stocks. So you saw the likes of previously relatively defensive companies like gaming, you know, the casinos, Sydney Airport with tourism, really be some of the hardest hit. The other interesting thing, and we heard Don earlier speak about what's happened with dividends. You know, it's incredible that we look now at the resource companies as being our income generators in this marketplace. I think something that a decade ago none of us would have ever dreamed of. So it really has, we've really seen a shift. And I suppose what's really been interesting is a lot of these managers have had to recalibrate both their investment objectives and also client expectations for where income will be. And finally, we saw a continued focus on the sustainability of their businesses. So we're still seeing a lot of insourcing of you know, Australian equity or management to the big super funds. We're still seeing fee compression. But interestingly enough, I think following both the bushfires and now COVID, we're seeing a lot of groups really spend up and put a lot of resources into ESG and sustainable investing. And we've very much seen a change from sort of that top-down demand to it very much being bottom-up client-driven demand. So that's a real positive that's come out of this. So on that note, I'm going to reintroduce Blake, Don and Michael so that we can start on some of the questions that we've got today. So thank you all for joining me again for this session. Now I'm going to start off with a question for you, Don, if that's okay. We've just come through the September the reporting season. What are the key takeouts from the recent season that you've seen? And then I'll throw it open to the other two to discuss as well.
Yeah, well, as I said in my talk, I mean, one of the key issues is how unevenly distributed the impact of COVID has been. You mentioned Sydney airports, and who would have thought Sydney airports would not pay distribution? Yet we see, some of the retailers like JB Hi-Fi going gangbusters, even Harvey Norman. I mean, Harvey Norman I don't know if you remember, but its first reaction was to cancel its dividend. It's, oh, we're not going to pay a dividend, that's it. About 2 months later, it says, hang on, actually our sales are going pretty well. We're going to reinstate a dividend, they'll be a bit lower. And now their sales are going gangbusters. So, I mean, some people thought was initially going to be really, really bad for those stocks actually worked out very well. But then others, like Qantas probably won't pay a dividend for 5 years. The banks are obviously going to be significantly challenged. So it's a real chalk and cheese market. And so you've got to be flexible because the old norm of we'll rely on dividends from banks ain't going to cut it in this world.
Michael, I might cut across to you over in Brisbane to your views on the most recent reporting season.
Sure. No, thanks, Veronica. So we saw pretty heavy downgrades coming into reporting season, but then in the last month or two before reporting season and including reporting season, there wasn't a lot of move in the overall earnings for the market. But I guess what surprised for everyone were the resource companies, so across iron ore, so Fortescue, Rios, BHP, the energy companies who saw higher oil prices bouncing back from their lows, and gold stocks tended to have the upgrades. As Don alluded to, retail was very strong and a lot better than people's expectations, and that continued in July. And that's from all the stimulus that's happening. In fact, in the June quarter, there was more people had more money than they had in the March quarter. And in terms of July and August, it started off really, really strong in terms of sales for most of the retailers. And that's because July was the biggest stimulus month out there. So we had JobKeeper, Job Seeker. You could get the second lot of your super money out, and much easier getting it out the second time than the first time. So there was a lot of money that taken out in that in the month of July, as well as loan deferrals as well. So just a lot of money sloshing around, and probably the younger people, the younger generation, doing most of the buying. In terms of what disappointed, I guess there are a few companies that disappointed. Don alluded to the consumers, Qantas, and Telstra was a disappointment as well. And we didn't particularly appreciate some of the deterioration in the legacy business and how quickly that would happen. But in terms of capital raisings, we didn't see many capital raisings during reporting season, a lot prior to reporting season, and we only really saw out of the majors Sydney and at Tabcorp come through in reporting season. So we were probably expecting a few more to raise capital during reporting season.
Blake, did you have anything you'd like to add to that?
I think the only thing I would add is that, in the depths of coronavirus, it's pretty easy to paint a very bearish picture. Obviously, governments have acted, and what we've seen is it's probably a little bit more than they needed to do, but that's easy to say with hindsight. So I think actually the stimulus is going to be a good thing. It's probably egged on a little bit too much, but what it's allowing is the economy and businesses to bounce back quicker than there would have otherwise been if there was a lot of damage out there. So, you can see it in the bankruptcy data, it's too low. There's going to be a catch up. But overall, I think the key point for us was that the stimulus is working, and so, if we can get back to more normalcy sooner, we could be back on track faster than expected.
Michael, I might throw over to you for the next question. We've seen the market continue to really ascribe high and expensive valuations on companies with strong growth potential and steady or rising margins. Do you think the current valuations are justified given where the real economy is?
Yeah, so that's a good question. And in my presentation, I talked to interest rates being as low as they are, just justifying higher valuations. So to an extent, in the market, it does make sense that valuations are higher. That you can't get returns from other asset classes, and as I said in your DCF, you do get a higher valuation from applying a lower for longer interest rate as your risk-free rate. So it does make sense. And Don's probably better at answering this than me, what we should probably expect is lower returns over time. So maybe the dividend yield is not 4.5%, maybe it drops down to 4% over time, given the current environment. So I think that's probably the main points for me to say there.
Okay, great. Don, we've seen that equity income products especially, a lot of them didn't hold up as well in March as what we would have expected, considering that they typically have a lower beta to the market. Why do you think that was the case?
Yeah, well, I must admit we did question why a lot of our competitors have struggled because, I mean, we actually performed pretty well. We actually outperformed on the way down and we outperformed on the rebound. So we're a bit puzzled, but I think you look at, there's probably two camps of competitors in the equity income space. There's those that probably have almost a permanent bias, and I think this is counted against them, towards the banks and Telstra and those stocks. And clearly they've struggled because bad debts are going to, I think, be a lagging indicator of this cycle, and they haven't really bounced back as much. So I think, and even they've been probably overweight some of the Sydney airports and those transurbans and things, which you would have thought wouldn't be cutting their dividends, but who would have thought this 12 months ago? So I think they've been slow, or they maybe still haven't changed their weightings in those areas. And then there's the buy right strategies, which sell call options, own stocks, get the income. I mean, the problem was if you were selling call options, say early March or February, you weren't getting much option value. The premiums were pretty low at that stage. So you didn't get paid very much, and then the market fell very, very rapidly. So it didn't really protect you at all. Yes, you would now be selling them at a higher option value, but if you're stuck in those stocks like the banks, you've underperformed. So I think it's partly, and you sort of alluded to us, if you haven't been dynamic and changed your spots and reacted to what's happening, then you've been left behind. And if you are still stuck in the old world, then you've probably struggled.
Do you think that because of that, it's worthwhile for at least retirees to start thinking more about total returns rather than just income?
I think they should always think about total returns. That's why we've always marketed our strategy with dual objectives. One is obviously income. It's an income strategy. They want high income. But what's the point of having high income if your returns are going backwards? And so we have a dual objective, which includes total return as well as income. And I'm happy to say we've actually, met both of those over the longer term, but we've definitely in the shorter term, we've continued to do that. I mean, we do have to recalibrate, I think, the level of income that will be generated going forward, and that has come back a couple of percent at the market level. And we've always, again, said our income should be relative to what the market's delivering, and so we still should be able to deliver more than that, but not as much in absolute terms. But clearly, look, you've got to look at the total return. There's no point in eating into your capital. And that's the way to run into the pension pretty quickly.
Absolutely. And Blake, I suppose a question for you, and I can't go past asking this after your presentation earlier. Is value dead as a style?
Yeah, I don't think it is. But as you highlighted, classic value strategies have underperformed and have done so for quite a long period now. Now, some of that can be put down to low rates, where growth stocks have done very well, and part of it is due to just genuine structural trends in online. But when it comes to valuation, I guess what we're seeing out there is that some of the best value opportunities are probably more in the resource space. And the reason we're seeing them there is because you've seen demand fall away. We've actually seen supply destruction. So people shutting down mines, whether it's lower capex in oil or copper, even iron ore in that space. And so that's actually when we're thinking about value at the moment. We're really focusing more on the cyclical value, because some of the stocks that have had structural trends against them, financial services is a good example, those stocks haven't rebounded, and we don't expect them to rebound quickly. So, when we're thinking about is value dead, it's absolutely not dead, but you need to be smarter than just buy stocks that have gone down.
And I might just stay with you for a minute before I open it up to the rest of the panel, but you just hit on a really interesting point here about structural changes. And, there's a lot of people out there that are saying we are starting to see some real structural changes. And if you just think about the fact that we've moved as an economy to online shopping much quicker than what was expected. There's now an expectation that, for example, the demand for office space won't be as high because of the realisation that a lot more people can work from home. How does this factor into when you're building your portfolio, these structural trends possibly coming into effect far quicker than what we may have expected?
Yeah, I think that's absolutely correct. And every company has a price. That idea says, if there is a structural tailwind behind you, you've got to factor that into the cash flows. So what we're seeing is, if this was online penetration, COVID's taken it up a level. I don't think it's going to go exponential again. So there's a question over some of the online, particularly in online shopping, may come back to retail. So you may fall above where that trend was, but you're not going to come back to it. in some cases, you're going to stay at that high level and go on as people have enjoyed it. I think online shopping for supermarkets would be a perfect example where there's many who said, I don't trust it, they've been forced to do it, and they've actually liked it. So I think some of those online trends have definitely changed the game. But you've always got to remember the market's pretty smart. You know, the market doesn't sit there and say, oh, if online keeps growing, we'll keep re-rating you. The market moves very, very quickly. And so the key question is, what's in the price? And some of these stocks, in our view, particularly in some of the online growth, heavy tech names, have probably overshot the mark. Some of the retail stocks have probably been too harshly dealt with, but there's a lot in between as well. And that's where you've got to be so stock specific because everything's different.
Sure. Michael, I might cross over to you to get your view on this structural change that's occurring.
Yeah, so I guess if you're talking retail, structural change, it's been happening for years and we've just seen an acceleration. So we had pretty low penetration of online and retail in Australia relative to the rest of the world. So we're effectively playing a little bit of catch up there. And as Blake said, some of those valuations are pretty ritzy in terms of some of those online stocks. When we're looking at those online stocks, where it all comes down to price and what's factored into the price, how many, what level of growth is factored into the next 10 years worth of cash flows. So, and in a lot of those cases, they are looking particularly expensive, particularly when you've got Amazon sort of hovering behind the scenes. And we were talking Amazon maybe 3 years ago, and the market got really concerned about Amazon coming in, and some of the retail valuations got hit then, and then nothing really happened with Amazon. But I think now Amazon are sort of licking their lips and going, wow, this online penetration is probably about the rest of the world. Now we can come into Australia and it's a real market where we can see opportunities. And Amazon are increasing, they've announced they opening DC centres, 2 new ones on the East Coast. So it looks like they're almost ready to really have a go in online. So seeing some of those really high valuations for online stocks in Australia, I'm just a little bit cautious given the Amazon effect that could come. And I know in the past it didn't flow through, but I think this time it could be different. So we are wary, and we're looking in the value space at some of those stocks that have been left behind. In the case of Scentre Group, it's trading on almost half its NTA, so it's been overdone, and it's not dead retail, and people will continue to go to shopping centres, and the shopping centres will evolve over time to be, and they have been evolving to be, more entertainment venues rather than just straight shopping centres. So as Blake alluded to, people adapt and businesses adapt, and so these businesses will adapt. But some of these stocks, it's been way overdone in terms of the uncertainty in relation to how far exactly online penetrates.
Great, thank you. Don, did you have anything additional to add to that?
I agree with my fellow colleagues here. I think that it was accelerating trends that were already there. I mean, the office one's an interesting one, actually. I think we haven't talked much about that, but I think it'll be quite a while. I mean, Pinnacle here, the view is that it'll be quite a while before we all go back and have to go back into the office, whether we ever do. But we'll need more space when we do go back in the office. So it's a bit of a, we may not have nearly as many people in the office at any point in time, but you'll need more space there. But it is the case, I think, we actually have a few people coming to the office, that it's much easier to collaborate. And that seems to be, in the last few weeks, a few groups are saying that you do need to sort of throw ideas around in a room. It's hard to do that in a Zoom or a Teams environment. And so I think it's, the office is not dead, but it's a little bit sick at the moment. So it'll be interesting to see how that goes.
Definitely. Michael, I might ask you a question. With regards to growth stocks especially, has FOMO behaviour crept in? Where else would investors possibly place their money?
Yeah, well, that's a good question, FOMO. I mean, my personal view is that the fund managers out there haven't particularly been caught up in FOMO. A lot of us have been left behind in terms of afterpay and the buy now, pay later, and that's been underweight that part of the market, but it doesn't feel like people have been chasing that part of the market. It feels like the chasing has been come from retail. And I saw some numbers recently about retail accounts, and they were talking about 300,000 new retail accounts being set up in the last 6 months. And so retail is having an effect on some of these share prices, and in the scarcity of genuine growth stocks. in Australia is fueling that as well. So from what I see, I don't think there's a fear of missing out. I think most people who've got most fund managers who've got a balanced portfolio will look at both growth and value, and will be disciplined with the way they invest and follow their strategy and processes. You don't want to deviate too much from those. And I don't think people are genuinely going too far outside their processes to find opportunities. But we find enough opportunities in terms of growth, and we're starting to see more in terms of value. And growth won't outperform forever. It won't re-rate from 40 times where it is now to 60 or 80 times, or is unlikely to. And so, if anything, maybe it's just a little bit toppy at the moment in certain pockets of growth, but we still see good opportunities in certain growth stocks. And as I said, there are some opportunities in value just showing themselves now.
Blake, I might ask you this question and then sort of ask the rest of the panel members as well. What is it that is keeping you awake at the moment, not just over the short term with regards to your portfolio, but over that medium to longer term as well?
Yeah, I mean, I think in the short term, it's got to be the stimulus. There's just so many things out there that aren't quite making sense. You know, as you mentioned earlier, the fastest drop we've ever seen in markets, followed by Harvey Norman reporting, almost 40% comps through July and August. Like, something's not adding up there, and the answer is just how big the stimulus has been. So how does, and what path, this is in the short term, what path did the government take to wind back that stimulus? How good are the banks going to be at chasing up, that roughly 10 to 12% of mortgage borrowers almost globally who aren't paying their mortgage at the moment? So that to us is what's occupying a lot of our time, although you're never going to get the timing right of that, and it's going to be very dynamic. But what we've seen so far is governments are going to err on the side of more stimulus rather than less. In the longer term, what we're doing is sort of the same. So the biggest debates we're having is, what's the future of office? Are there investment opportunities there if people get too bearish? What our experience has been to date is that the market hasn't actually marked these office stocks down that much, in our view. It's not like they're being belted down so far. We're actually still seeing a lot of buyers transacting in the space post-COVID in the last month at book value, pre-COVID book value. So there's just so much money out there that these asset values aren't really changing as much as you'd normally think. And then the other debate is online, and particularly competition. So we can see the trends, but we also know that the money's free and people are happy to take on losses for now. So how much competition is coming into each individual space, and really highlighting, particularly if we're going to play in the online space, a company like Seek, which we talked about earlier, making sure they're investing to make sure they keep everyone else out. That may mean profits are lower in the short term, but we feel a lot more comfortable owning those kind of businesses that are investing rather than harvesting.
John, what's your view on it, especially coming at the fact that predominantly most of your investors are retirees, and the need for stability in special capital stability is so important? What are the things that are really concerning you?
Well, I mean, the thing that I worry about, a little bit like Blake, but is when the stimulus is reduced, because I think that we're just kicking the problem down the road, kicking the can down the road, particularly like the banks. I mean, if you actually look at the last recession that we had, the recession was 90, 91. Westpac nearly went broke in 92. So bad debts are a lagging indicator, and particularly if you're going to pull the stimulus out and reduce JobKeeper, etc. To me, I'm more worried about next year than this year. So as that stimulus comes off, it is going to be very tricky, I think, for the government to try and get us through this sort of period. And I think the worst is still ahead of us for many stocks, particularly, say, the banks. And the retailers have had a great run, but I think some of them are going to struggle a little bit. So, I am worried about next year more than this year.
Michael, just in relation to what's been said, I might also ask you the question of, especially with regards to the fact that you short in your portfolios, is there being so many unknowns really making it difficult with how you go about your shorting positions?
Yeah, what helps us and any active manager in the market is volatility. So volatility creates opportunities. So for us, it's not harder at the moment to find opportunities. We look at it's shorting in terms of outright shorts. So is there a specific reason why you think a stock's going to go down? Or secondly, we look at funding short stocks that potentially just won't do much for the next little while. They might perform in line with market, but can fund some of your higher conviction position longs. And then finally pair stocks. So within a sector, what do we, and then we do this in macro sectors, what stock do we like versus the other stocks. So some of those outright shorts potentially are some of the harder ones to find in this environment, given the level of volatility. But the rest of the shorts, the other 2/3 of the short portfolio, which is about 20 of the 30%, is not particularly any harder in terms of finding opportunities for outperformance.
Okay. Now, I just might ask the final question, and again, it's one for the whole panel, but I'll start off with you, Blake. Following, as I said earlier, the bushfires and COVID, there's been a real bottom-up demand for ESG and sustainable investing. As a business, what is Firetrail doing, if anything, in this space, and what kind of demand are you seeing?
Yeah, so we're doing a lot in the space, but we've always had a very consistent philosophy around ESG, which is, first of all, you've got to own it. So each analyst owns ESG for their sector. And the reason we do that is because a centralised person can't possibly be an expert in regulations, in trends across specific sectors. So first, always ask the expert. The analyst has got to own it. The second thing we do is measure it. So rather than saying, coal's bad, coal's good, we're not doing this, we're not doing that, we don't do that. Every company has a price, but what we want to do is measure the impact. So when we're talking about ESG issues, maybe it's in coal. If it's a coal-fired power station, we don't own any, but if it was, we'll do a shorter life. You've got to, if there's bad behaviour going on, what impact is that going to have on the valuation of the company? And so applying discounts where warranted, and sometimes premiums, because one of the biggest areas we see at the moment is decarbonisation. And it doesn't necessarily mean we're going to build more wind and solar. What it can mean for a company like Worley, which we own, is that they've got a lot of oil and gas customers, and people say immediately, oh, that's bad. But what we're seeing is actually these oil and gas customers are wanting to decarbonise their existing assets and are willing to spend a lot of money. And you saw BP just recently being very proudly putting out the fact they're going to decline their oil production by 40% by the end of the decade. So there's a lot of money swashing around, and companies who could be seen negatively in ESG terms could be positive. So we're not just thinking about risks, we're also thinking about opportunities in that framework.
Don?
Yeah, I mean, look, we've been looking at this area for many years. I mean, we've been monitoring the carbon of our portfolio for over 5 years, signed up to Montreal Pledge over 5 years ago. So it's not new to us. I mean, I think I actually haven't seen that much more increased interest from the end investor. I think researchers are certainly asking a lot more questions here, but we put in what we call our 100 red flags as a sort of warning indicators, and about more than 50% of those are ESG type flags, a lot of governance, but some of the social and environmental factors, and also the forensic accounting factors, which is an extension of governance. And that's one way we've been able to I suppose, sidestep a few of these bad apples over time.
And finally, Michael, did you have a view on sustainable investing?
Yeah, sure. So what we've seen over, I guess, since the bushfires is we've seen a number of investors, or quite a few of our wholesale investors, hit us up with questionnaires, just trying to understand the extent of the research we do in terms of ESG, and that's ranging from identifying stranded assets to what Don mentioned before, measuring carbon intensity in the portfolio and measuring that relative to the benchmark, and how do you go. I don't think anyone really has a stance at the moment and particularly want you to go either way. They're just trying to understand what you do, and then the questions that you ask the companies and how they're going to survive in the new world over the next 20 to 30 years. Now, we do have one client that is looking to decarbonise over time, so they've got a 10-year plan to reduce the carbon within their portfolio, which will be interesting to see how that plays out with the fund manager. So there is more that's happening in the space, and that has sort of been kick-started by those bushfires. We've got a dedicated ESG analyst who we've had in place for the last 12 years, and so she is very helpful in steering us in the right directions. That's the analyst, that is, and putting us at the forefront of the topics in ESG before we get asked by clients.
Great, thank you so much. And on that note, I'd really very much like to thank Blake, Don and Michael for joining me today for this session. That's the end of it for today, and I very much hope you can join us here and the Pinnacle team for future sessions. Thank you.